Hello, this is your daily dose of financial market trends. AMD is plunging in pre-market trading after SpaceX's first ever earnings report revealed massive AI infrastructure spending plans that are rattling the entire semiconductor sector. Let's break down what's happening. Heading into today's session, yesterday's close had the S&P 500 sitting at 7,736, up 1.79%. The Nasdaq finished yesterday at 26,585, gaining 2.59%. The Dow closed yesterday's trading at 54,086, up 1.71%. The VIX ticked up just over 1% to 16.67, while the 10-year Treasury yield pulled back 1.28% to 4.63%. Let's start with AMD, which is getting hammered in early trading and dominating conversation across the market. The chipmaker is diving after reports tied to SpaceX's surprise earnings reveal. And we're seeing intense activity in social channels, with massive engagement spikes. The concern seems to center on broader questions about AI capital spending and whether these massive infrastructure investments will actually pay off. For AMD specifically, investors are wondering if their AI chip roadmap can compete when even well-funded players are facing scrutiny over returns on these enormous bets. This isn't just an AMD story. It's raising questions about the whole semiconductor AI thesis. NVIDIA is also catching attention today, though in a more mixed context. The AI chip leader is showing up across multiple data streams with strong social engagement and price movement. NVIDIA gained over 2.5% recently, but the SpaceX capital expenditure concerns are creating some hesitation. The core question investors are wrestling with: if SpaceX can't articulate a clear path to monetizing AI infrastructure, does that cast doubt on the customers buying NVIDIA's chips? It's a second-order effect worth watching, because NVIDIA's valuation depends entirely on sustained enterprise AI spending. Alphabet is drawing serious attention as the SpaceX AI spending story ripples through big tech. Google's cloud and AI ambitions put them squarely in the crosshairs of this debate about capital efficiency. Engagement around the stock has spiked significantly as investors reassess whether the hyperscalers can justify their own infrastructure build-outs. If the market starts demanding clearer ROI timelines from AI investments, Alphabet and its peers could face multiple compression even while their underlying businesses remain strong. Finally, Astera Labs is seeing explosive interest with extraordinary engagement growth and a double-digit price jump. The AI connectivity chipmaker is riding unusual volume as traders look for plays beyond the mega-cap names. With a gain of over 12% recently and significantly elevated trading activity, Astera is becoming a favorite for investors who want AI exposure but are nervous about concentration risk in NVIDIA and AMD. It's a smaller name, so volatility cuts both ways, but the buzz is undeniable right now. On the geopolitical front, we've got three major scenarios moving markets today. First, tensions around the Strait of Hormuz are escalating. Iran is threatening to close this critical shipping channel while the U.S. issues warnings and diplomatic talks continue. The bull case, sitting at 45% probability, is that negotiations succeed and Iran backs down. If that happens, oil prices would drop sharply as supply fears evaporate, lifting airlines and transportation stocks while putting pressure on energy names. Broader markets would rally on reduced risk and lower input costs. The bear case, at 30%, is that Iran actually restricts the strait and the U.S. responds militarily. That would send oil spiking as 20% of global crude supply faces disruption, triggering inflation fears and potential Fed hawkishness. Energy stocks would surge, but broader markets would sell off hard on stagflation concerns. Second, SpaceX's AI capital expenditure reveal is creating serious uncertainty. The bull case at 35% is that SpaceX demonstrates clear revenue synergies between their satellite network and AI infrastructure, with credible monetization plans. That would validate aggressive AI spending across the tech sector, lifting hyperscalers and data center names. The bear case, at 40%, is that SpaceX fails to justify the spending, triggering broader skepticism about AI infrastructure returns. That would pressure semiconductor and cloud stocks as investors demand clearer profitability paths, with defensive sectors outperforming. Third, the U.S. is implementing new export restrictions on critical minerals essential for tech manufacturing and clean energy. The bull case, at 40%, is that the ban successfully builds domestic processing capacity without major retaliation, benefiting U.S. semiconductor and EV makers through prioritized material access. The bear case, at 35%, is that trading partners retaliate with their own restrictions, fragmenting supply chains. That would create severe material shortages and price spikes, hitting semiconductor, EV, and renewable sectors with margin compression and production delays. On the housing front, the 30-year mortgage rate sits at 6.66%, down slightly from a year ago. We're seeing cautious stabilization with existing home sales up nearly 3%, but inventory is building to 9.3 months of supply. If that inventory keeps rising while price growth stalls at just 1.1% annually, builders could face real margin pressure ahead. On the earnings front this week, we don't have any reports from our main watch list, so it's a lighter calendar to digest corporate results. Let me leave you with 5 things worth watching right now. First, the semiconductor sector is facing a reckoning on AI capital returns. When even well-funded companies struggle to justify infrastructure spending, chip makers need to prove their revenue models hold up. Second, geopolitical risk is back in a meaningful way. Between Strait of Hormuz tensions and critical mineral export bans, supply chain disruption is a real scenario that could shift sector leadership fast. Third, the AI trade is bifurcating. We're seeing rotation from mega caps into smaller specialized plays as investors hunt for exposure without concentration risk. That creates opportunity, but also higher volatility in names that move on momentum. Fourth, housing inventory is building faster than sales are growing. If that trend continues, homebuilders and related consumer discretionary names could face headwinds, even as transaction volumes improve modestly. Fifth, Treasury yields pulling back while equities rally suggests the market still believes the Fed has room to ease if growth wobbles. That's supportive for risk assets near term, but watch for any inflation data that challenges that narrative. As always, this is educational content, not financial advice. Do your own research and consult a professional before making investment decisions. That's your morning market digest for Wednesday, August 5th. I'll see you back here tomorrow morning with the latest. Trade safe out there.